Welcome to
Okay.
Corey and Valerie. I'm so excited to have this intimate evening with you.
Thank you.
Over to you, Denise.
All right. Thanks, Margaret. And like Margaret said, it's just Valerie, myself, Margaret, and we have Corey, who's also with SISIP out in BC. So this is my first time doing a virtual classroom, so this is pretty exciting. I think it's awesome. And what we're going to talk about this evening is your credit rating and why it matters. So it's kind of interesting because Valerie is in Hawaii, and I'm sure she probably has a, potentially has a Canadian credit report. So hopefully this is all going to relate to her as well. So my name is Denise, as Margaret mentioned, and I'm here in Trenton. This is where I live, and this is where I work at the base as a financial counselor, and I've been with SISIP for 7 years. I have over 20 years working in some way, shape, or form in the financial services industry. So my background brings me to working with a government agency in Nova Scotia for 3 years, and then I've worked for 9 years with CIBC. So I've always kind of been in the financial world. And I have my Bachelor of Commerce degree. And I'm always looking for interesting ways to change things up outside of my daily life. So that's a little bit about me. So Canadian Forces Morale and Welfare Services is what we fall under, and as you can see, we're down there at the bottom with SISIP, right-hand side, and we're in there with Military Family Services, we're in there with PSP, we're in there with CANIX, we're in there with JPSU. So we all report to the same big guy at the top, Commodore Watson, who's now leaving, and we're going to be getting a new leader. So the vision of SISIP, this is SISIP's vision, is that every member of the CAF community and their family has financial health and security. So that's our vision, and that's where we're heading. We have been for a number of years, and part of that vision and health and financial health relates to your credit report and your credit rating. So that's all part of financial health, and that's going to be our topic tonight. So I'd just like to bring up a poll, if we could. I'm going to ask, we have a little question here we're going to ask, and it's a yes or no answer. And I'm going to pass it over to Margaret to put up the yes or no question.
All right, so I'm just going to set up the new poll here. And just 1 second. Okay, we're going to open the poll.
And so it's open?
There we go. Now it's open.
So the question is, have you ever seen a copy of your own credit report and or your credit rating? So the answer is yes or no. You can go ahead and choose.
I'm going to now close the poll and show you the results. It always takes about 30 seconds to open and close the poll.
Okay. So 2 out of 3 have answered yes, and 1 person didn't answer. So
mine would be no.
So you are the no, okay. And then Valerie and Corey have seen a copy of their credit report. So a lot of stuff that maybe we're going to talk about you may already know, so it may just be further recapping what you already know about your credit report and your credit rating. You may have only requested your credit report and not your credit score, or you may have done both, but we'll go over both of those tonight. So this next slide just showing credit report and credit score. And the young guy is out buying a car, and he says to the sales guy, just because I missed paying a few bills in the past, I have to pay how much interest? And so he's probably questioning why he has to pay more interest because he missed a few payments. And it can simply be that missing a few payments can have a bearing on your credit report and your credit score. So credit report and credit score, they're kind of two different things. A credit report, as it tells here, is a detailed report of your credit history. So it's going to tell you anything that you have with borrowing money in any way, shape, or form is going to give you a detailed report of that history. That's what your report is. Your credit score summarizes that information at any point in time, and that scale can range anywhere from 300 to 900. That's a score. And so what it's basically saying is that the higher your score that you have, so if you're closer to 900 than you are to 300, then you are a low risk to a lender. So if someone's looking at lending you money and you have a high credit score, then they are more apt to probably lend you money. And they're also probably more apt to lend you money at good interest rates and at good repayment terms, so that you can pay it. And in turn, that gives you good financial health if you're paying less interest to creditors. So what's in your credit report? So if you both, Corey and Valerie, you've each had a copy of your credit report. So you already may know some of this. So it shows your name and your address and your date of birth. It should show your employment information. It will show all credit accounts and transactions. So credit accounts would be credit cards, it could be loans, it could be a line of credit, it could be a cell phone company, and it will show transactions. Now, when it says transactions, it's not showing your everyday transactions, it's just showing how well you're repaying those credit accounts. It'll also show any public records like a bankruptcy, judgments. So any of those are public records, they will show on your credit report as well. That has an interest to lenders, whether they're going to lend to you or not, if you've been in a bankruptcy before. If there's any accounts that are in collections, they're also going to show on the credit report. And any inquiries. So if someone has been checking your credit, you've been seeking credit, applying for credit cards or applying for loans, then those creditors are going to do an inquiry on you, and they're also going to show in your credit report. So we'll go to the next slide. And again, you may have seen this on your report. The credit ratings are broken down into normally three different, I guess, terminologies. And one is an I. So you have an I rating, an O rating, or an R rating. So an I rating means you've given credit on an installment basis. So can anyone give me an example of what type of credit would be an installment type credit? So would anyone like to give an answer of what type of an example of what an I credit would be?
Feel free to raise your hand. Corey.
Yeah, like a auto loan or any sort of term loan.
Right. So you're given credit on an installment basis. So an I would be like your car loan, or could even just be a personal loan, could be an investment loan, like an RRSP loan. So it's a loan, and that's what the I means. So at the end, when you're finished paying it, your finish is done and over with. Like your car. When you buy a car, you pay it for 4 or 5 years, and at the end of it, you've paid out your car loan. So that's an installment. Can anyone give me an example of what an O means? What O type of credit would be? This is an open credit. What would be an example of an O credit? Corey or Valerie, or even Margaret?
So yes, I think an O credit would be something along the lines of like a cell phone bill.
Okay.
Where you don't necessarily own the plan, it just you keep charging for it.
Right. So does that make sense, Corey and Valerie?
Yeah, and sometimes line of credit show up as O.
Sometimes line of credit will show as an O, that's correct. Sometimes they show as a C as well. So we've only got here listed I, O, and R, but I've also seen lines of credit showing as C. Anyone seen that? Have you seen that, Corey?
I believe so, yeah. The member usually knows what it is. But.
Sometimes they do, yeah. And then we have R. So R means revolving. So can anyone give me an example of a revolving credit?
That's usually your regular old credit cards.
Yep. So your credit card.
Or regular credit cards.
Yep. So it could be your credit card. It could be like a brick card or through Leon, your Sears. If you have a Sears credit card, that would more than likely report as an R. So anything that's revolving, and revolving just means as you pay it down, that available credit becomes available to you again and again and again. So it never ends until you either pay it out and close it, or if there's ever a problem with it, then it may be closed. But it's always ongoing, unlike an installment loan, which has an end date. So that's the terminologies you'll hear in credit rating. And then you'll see on top of the R, O, and I, you'll see anything ranging from 0 to 9. So I'm not going to go through every single one, but what I will tell you is that 1 means the best and 9 means the worst. So if you're paying everything on time as you agreed to do when you took on either a car loan or a credit card, and you pay it as it comes due every month, then you will probably have either a rating of an R1, meaning that you pay it on time, or an I1, like your car loan, meaning you're paying it on time. If you're getting down to an R3 or an R4, it just means that you're behind your payments, probably 3 payments or 4 payments. And then you're getting down to the R9 rating, which is the worst rating. That's when the debt, you're no longer paying the debt at all, and it may have been placed with a collection agency, or it's included in a bankruptcy or a consumer proposal. So if you're paying everything as you're supposed to be, then you're going to have an R1 or an I1 rating. Okay, does that make sense? So that's about credit rating. So then we're going to get into what factors determine your credit score. So it's determined by 6 factors, and some of it we've kind of touched on. So your payment history, so if you're paying everything, depending on how you're paying everything, that's going to determine your credit score. If you've ever declared a bankruptcy, that will have an impact on your credit score. How much money you owe. So if you owe potentially a lot of money compared to your income, then that could have a bearing on your credit score. And how long you have had credit. So if you're fairly new to credit and you've just maybe just obtained a credit card and you've only had it for a few months or maybe less than a year, then you haven't had it for very long. And so that's not going to start generating a good credit score for you until you've had it for a period of time. So how long you've had credit will determine your credit score. And the type of credit you use as well. So we'll go back to the I, the O, and the R, and it's sometimes good to have a little mixture of all of them to generate a good credit score. So if you're just using a credit card, that just may be enough to generate a credit rating. It may take a little bit of time. If you have a mixture of an I in there, which is your car loan, then that will also be a mixture. So if you have different mixtures of types of credit, then that will help with your credit score. Credit score is also determined by if you're trying to get more credit, and it could sometimes have a negative impact. So if you're trying to get more credit, can anyone give me a reason why that would be a factor?
Denise, I have an answer.
Okay.
So if you're trying to get more credit, that means more people may be checking your credit score. And doesn't, if people check your credit score, it could go down?
Correct. That's right. So it could mean from a lender's perspective, when they're looking at your credit score and they're seeing that you're trying to get more credit, it could be looked at that you're potentially living beyond your means, or that you're perhaps desperate. So sometimes that could be the case if you're trying to get more credit. And generally that is when it's all happening within a very short period of time. So if you're trying to get more credit in like all within 2 weeks, say for instance, or within a month, you're doing all these different inquiries, and that's going to have an impact on your credit score. And other lenders want to know that. They want to know what kind of risk you are, and that's what it's all about really at the end of this is risk. So if you are out getting credit, that could be a risk to their money that they are looking at lending you. So that's your 6 factors that can help determine your credit score. So credit information, the often question that's asked is how long do you see the information on your credit report? So this gives you the answer right here. Your history is normally there for 7 years. So anything that you've done in the last 7 years with handling credit is going to be there on your credit report. Okay, so not paying attention to what you're doing can have an effect on your ability to reach your goals. For instance, buying a house, buying a car, even just getting a credit card later on in life. If you have had some history in the past of being late, then that could have a bearing. The longer it is, the less of an impact it's going to have. So something that shows on your credit report from 7 years ago, it's going to show there, but it's probably going to have a less impact than if it was showing in the last 30 or 60 days. So ways to improve your credit rating. Sometimes if you just are going about paying your bills as you agreed to, you probably could have a very good credit rating, and there's probably not really a whole lot more you need to do to improve it. If you're paying it as you're supposed to, then that's all you need to do. And following some of those things we've already talked about, paying your bills on time, not carrying on too much debt, not doing too many inquiries, those are all things that are giving you a good credit report and credit score, so you may not need to do anything. But there's some people, sometimes the young people, that maybe had some history in the past that's affected them, and they want to find a way to improve it. So these are some of the different ways. So again,
Denise, excuse me, Valerie has a question.
Oh, I'm sorry. I got to pay attention over this side, don't I?
It's all good. Valerie, you're muted.
Yes, sorry. I just had a question about the credit rating. Does it have an effect if, for example, I'm in the United States and I'm using my credit card maybe once or twice a year just to keep it alive? Will my credit rating go down if they don't see any activity in my report?
It could. If you're using it once or twice a year, if it's just a credit card and that's all you have and you don't have like a car loan or a line of credit that's also reporting, it could. So if you're away, you may want to try to potentially use it every maybe 30 or 60 days so that it's getting reported to the credit bureau. Doesn't mean that you have to have a balance on it. You could just use it and pay it and use it and pay it. So 2 times a year, that could be not generating as strong of a credit rating as if you were using it more often.
Okay, because when we come out, like car loan has to be paid, things like that for importing cars. So I don't have anything, like I don't have a house in Canada, I don't have anything. So it means my rating right now is going low.
You just have the credit card then, right?
Yes. And I'm just using it once in a while, so I keep having a credit in Canada.
Yeah, no, I can't say for sure. Like if you're saying just twice a year, if that's enough, that may not be enough.
Okay, thanks.
Okay.
I had another question for you, Denise.
Sure.
So it says don't go over the limit on your credit card. Are you allowed to go on the limit? I thought they would block you if you reach the limit. They won't let you do any more.
A lot of times, that's what you would hope that that's the way it would go, but no. Unfortunately, some creditors will allow you to go over your credit limit. And sometimes it's just a matter of timing that they just can't catch it. Like if you're out shopping at multiple stores in the same day, one just doesn't catch the other, and it could allow you to go over your limit. Ideally, they shouldn't be, but ultimately they leave it in your hands as well to be knowing what your limit is and not going over it. Does that make sense?
Yes, thank you.
Okay, so that's the other important part, is not going ways to improve your credit ratings is to not go over your limit on your credit card. In fact, if we go right to the last point on the line, on this slide, what it's saying is to keep your indebtedness low. So what that's saying is staying below 35% of your credit. So ideally, if you have a credit card, you would try, say, for instance, $1,000 limit. You would try to not have you should try for your balance not to be any more than 35% of that, which would be $350. That's generating a very good credit rating. Mind you, if you're at 50% of your limit and everything else is good on your credit report, it may not have an impact on you, but that's the ideal. So when you're getting close to your limit on your credit card, then other creditors are concerned about that. They may think that you're living beyond your means, or again, that you're desperate. Don't apply for credit too often, and again, that was mirroring back to the previous slide as well, is if you're applying for credit too often, then that's going to have a negative effect on your credit rating. So oftentimes the question is, well, if I'm looking to apply for a mortgage, I'm applying to different places for my mortgage, is that going to have a bearing on my credit report? Ideally, if you're shopping for a mortgage and you're shopping around for interest rates, those creditors that you're dealing with are conducting your credit report in a very short period of time, so over a course of a couple of weeks. Generally, that's not going to have that much of a bearing. It will take a couple of points off your credit rating, but it should not affect you in a very negative way if everything else that you're doing is the proper way to handle credit. Pay off your debts as quickly as possible. So that's if you're carrying debt. Ideally, if you have debt and you're trying to get it paid, try to do it as quick as you can, and that will help improve your credit rating. If you're paying your balance and using it again, paying your balance and using it again, and right at your limit, like we talked about in the second line there of our slide, then that's not going to help you. So if you're going to pay it, you want to pay it as quickly as your income will allow you to. Corey, are you asking a question?
Pardon me?
I'm just looking at the side here, chat. Is it a good idea to order your report after the bankruptcy has been discharged?
Oh, yeah. Somebody asked about how long the bankruptcy shows on the report. And I just mentioned if you filed bankruptcy, it's a good idea once you're discharged to get your credit reports and forward the discharge papers to both reporting agencies, because every creditor reports on your credit. So a lot of the time after bankruptcy is not updated accurately, still shows balances owed and things not included. So that is a good idea for sure. So once you're discharged from a bankruptcy, we don't get in a whole lot about bankruptcies as such tonight, but we can touch on it about what your question is. So once you're discharged from a bankruptcy, it stays in your credit report for 6 years from the date of discharge, okay? But once you're discharged, like Corey is saying, you should get a copy of your credit report, order your own copy, and make sure that it is showing that you've been discharged. In most cases, most trustees will report to the credit bureau that you've been discharged. They should. I don't know necessarily that they are legally obligated to, but most that I've seen do. But it's always good to check and make sure that they've reported it for sure. So ways to improve your credit rating: build a strong credit history. And again, that's a lot about what we've been talking about: paying your bills on time, not going over your credit limit, not applying too often, paying your debts as quickly as possible, and keeping your balances below your limit. So we're going to move to the next slide. So this next slide talks about how to obtain your credit file. Well, Corey, you've already obtained your credit file, and so has Valerie. And I'm assuming, Valerie, this is your Canadian credit file that you're talking about. I don't know how things work in Hawaii. I'm not really sure. Do you know how that works there at all? Or so you do not have credit in the States? Okay. So it's just a Canadian credit that you have. So
lenders use a credit score to decide whether they're going to lend you money or not, and at what interest rate. So that's lenders, banks, department stores, car loan companies. They often use a credit score. Insurers, owners, and employers can use it sometimes to determine how responsible you are financially. So there's different people potentially checking your credit file. So it's always recommended that you check your own credit file at least once a year. I kind of pick January for myself at the beginning of the year, but it's always a good idea to check your own credit file. And there are two major credit agencies in Canada, and they're listed right here. One is called Equifax and one is called TransUnion. So I'm just going to share with you. I'm going to go to Equifax because that's the one that we use most often with SISIP.
So is the same information on both Equifax and TransUnion?
For the most part, most of the information will be the same, but it really depends on the company. So the credit, Equifax and TransUnion, they're a holding house. So they hold the information of whoever sends it to them. So most banks, you will see that they report to both. So if you have a credit card with CIBC, for instance, more than likely they report your history on that card to both Equifax and TransUnion. Not everybody does, though. So you will get some different information on each one. So that's why we recommend that you obtain your credit report from each of them, not just from one or the other. That makes sense?
Yes, thank you.
Okay. So now I'm going to share I get something done wrong here. Oh, okay.
So you're going to go to your web browser and you're going to put in the site. Right there, yep. To the left of that. Right in there. That's where you're going to put it in.
So we at SISIP use Equifax, not TransUnion. So that's the credit agency that we have an agreement with. So if we need to check a credit file for whatever reason, we go to Equifax. This is not the site that we use. This is for consumers. So consumers, if they want to get a copy of their credit report, they will go here. So it's funny because I was on there earlier today, and it's got a third one in there called Experian, and I'm not 100% sure about that one. Have you heard of that, Corey?
Yeah, I think that's for the states. The U.S. I think has 3: Experian, TransUnion.
Okay. Yeah. So I've been on their site a few times leading up to this, and this is the first time I've seen Experian on there. So I'm not going to talk about Experian because I really don't know anything about it, but Equifax and TransUnion are the two major ones in Canada.
Yes, when you look at the site that you put in, there is US right there. It came up beside English. Interesting.
Okay. So, and it was CA we put in. So I'm wondering, okay. So right down right here in the middle of the page, you can see you can receive a free credit file disclosure from Equifax via Canada Post. So that's where you would go if you'd like to order a free copy of your credit report. And it has to be mailed to you, but you can order it over the phone. You can fax in a request. And here it tells you, it's just basically a one-page form. So when you fax it in, you do need to send in identification. You fill out all of your information, and you sign it, and you send it. If you would like to get a copy of your credit score, however, it does cost money. So if you see at the bottom here, it says that, yes, I would like to purchase my credit score for $11.95. Okay, so that's how to get a copy of a free credit report. So everyone is entitled to a copy of their own credit report for free. If you would like to get it instantly on that website, you can get it instantly, but you'd have to pay for it, and you'd have to have a credit card to do so. So there's different options within that of ordering it online. There's different pricing depending on if you just want your report or if you want it with a credit score. There's different prices.
Can I add something?
Yeah.
And two, if you're ordering online, it's happened to me. You just got to be careful because they make it kind of tricky. When you order online, they kind of sign you up for a monthly monitoring subscription. It costs like $15, $20, so you're paying that each month, and they'll send you updates if anything's going on in your credit, which is basically, unless you're applying for stuff, I mean, it's not really worth the value. So
yeah,
just if you're ordering online, just double check on.
Just make sure you're
yeah,
not
because the wording is pretty tricky, and it's signed up for a subscription, a monthly monitoring.
Really? It would
yeah, and it's not really worth the dollar value, right?
Yeah.
Just a little note.
The only time I've ever seen that really be a good dollar value is if you've been a victim of identity theft or fraud.
Yeah,
that
but then you could always put an alert on your credit report too, right?
Absolutely. Absolutely. Yeah. Yeah. So just be careful when you're ordering it online and not signing up for a subscription. Because we didn't go through the whole website, but like Corey says, there's different options in there. Like he said, you can go on like a credit watch that costs you a monthly thing, but you can just get your one-time credit report instantly for like, I think it's like $24.95 or something like that. So that's obtaining your credit file for free or getting your credit score. So attitude towards credit and debt, and this is, I guess, one guy is like, yep, no problem, and the other guy is running the other way. So some people take on debt without hesitation, others avoid it at all costs, and some of us just fit within the middle somewhere. So your attitude towards spending and owing money affect whether or not you will borrow and how you can handle debt when you do borrow the money. So sometimes it is attitude. Some of the causes of financial problems that, and in Corey and myself, we can certainly attest to what we see in our offices as being counselors. These are some of the causes of what gets people into probably having financial problems. So needs versus wants is probably one of the, I would say, probably one of the biggest ones that we see. Would you say, Corey? Yeah. Easy access to credit, again, another one that I was, just chatting with Margaret before the call, and, we were talking about how things were back in the 60s and the 70s, and if our mom or dad wanted to get a mortgage, I mean, they had to go through a lot before they would be able to get approved. So today, it's very easy, and there's so many different forms of borrowing. Not having a proper working budget is another one. Corey did one of these 2 weeks ago on Budget 101, and I know the presentation is up on our website, and I'm pretty sure I saw it today on MFRC PEI's website as well, parts of it at least, about how to prepare a budget. Sales strategies, buy now, pay later strategy. Getting people into sometimes some trouble. So like your Leon's and your Brick, you see the big signs, buy now, pay later. Even borrowing in general, you're buying it now and you're paying it later. So those sales strategies are having an impact and can cause financial problems. Rational versus irrational financial decisions. Probably another one of the bigger ones actually would be not involving your spouse. So that's having a bearing on problems, not talking about money, not having same goals potentially. So not involving your spouse causes financial problems, and financial problems can also cause marital problems. Not being prepared for the unexpected, and that's all kind of part of budgeting as well, and limiting your usage of credit. So when you're not prepared, you resort to credit, and sometimes that can cause financial problems. And of course, there's other things that sometimes are out of our control too, like the loss of job and being married to military members, like yourself, Valerie. I am married to a retired military member, same thing. So we're moving around the country and we have to find new jobs when we move. A marital breakdown, of course, can cause financial problems, and sometimes just acts of God, fires, floods, things like that. Financial problems can also be caused by illnesses in the family, sometimes substance abuse, sometimes gambling, isolation. So those are causes of financial problems. Pros and cons of using credit. So there's lots of pros for using credit and there's lots of cons. So some of the pros is that it just allows you to perhaps purchase larger items that require saving over a lengthy period. So that probably could be, what would an example of that be? Can anyone answer that? Why using credit for a large purchase? Like what kind of a large purchase would that be?
Like a house?
Yeah.
A car too. Or
a car. Right. Pros, establish a good credit history. So having credit is kind of one of those catch-22s. You need to have it in order to create a good credit history, but you don't necessarily need to have it to incur debt. So you need to have it to create a good credit history, and that helps you when it comes to those big ticket items. If you have a good credit history, then you're more apt to be approved for lending and be approved for good interest rates. And sometimes it can be used to pay for unforeseen expenses, perhaps breaking down on the side of the highway and you have a car repair and you just need that credit card to get you through. So those are some of the pros. Some of the cons, of course, is that when you borrow it, you need to pay it back. Wow, darn. So there's nothing free about it, right? Interest is added. So this is really the effects of compound interest. So as you borrow money and you're paying interest, you end up paying back more because you have to pay the creditors their money that they earn, which is the interest rate. And if you're paying back money is going towards paying off debt, then it's really hard to potentially achieve other goals, such as maybe saving for a vacation or saving for your children's education. So it becomes a little bit harder. And if you fail to repay your loans, then it can lead to a bad credit history, which in turn leads to being declined for credit, and then in turn leads to high interest rate creditors. So you don't have the option of negotiating. So good and bad debts. And so oftentimes, this is one of the, I find a very good education piece because a lot of people get it all mixed up as to what's good and what's bad. And really, there are only two good debts, and that's a home or a student debt. And it has in here a business as well. So those are really the only two good debts, even though probably most of us can't buy cars with cash and we have to borrow it. I think it's just really getting back to being responsible about how we do that. But really, those are the only two good debts. Everything else is pretty much what Pat Foran, who works for CTV, he wrote a book on managing money, and he calls it junk debt. So that's basically your credit cards, and sometimes can be considered your car loans. So it's your credit card debts that you just cannot pay in full. It's losing value. It has no value attached to it. So we're heading into the next two slides. Is everyone okay? Does anyone need a couple minutes or any
Give us a green check if you're ready to continue. Do you have any questions? Great. Thank you.
We're good to go. So the next two slides are talking about debt ratio. And so can anyone tell me what it means? What does it mean? Although I guess we're probably giving you the answer there. So your debt ratio is how much money you owe compared to your income. And that's basically what it means. So here's an example. Your monthly payments of money you owe are $200. and your monthly income is $2,000. So your debt ratio is 10%. And what it's saying here is that you should keep your total debt ratio below 35%, and that's including your mortgage. Okay, so that's kind of the general threshold for lenders. When they're looking at lending money to you, probably the first or second thing that they're going to do is calculate your debt ratio. They want to know what it is. And in Canada, the maximum, for the most part, for most major creditors, they don't want to see your debt ratio any more than 35%. If you're over 35%, then you're becoming a risk. Ultimately, it shouldn't be your only deciding factor, however, when you're looking to borrow money. It shouldn't just be your debt ratio. This is just one of the factors. I believe that you need to come back to your budget, and that's what you need to make how you need to make your decision. Like, knowing your debt ratio is always good exercise to go through before you go to borrow more money. This is another example, goes into a little bit more detail. The last one is just $200. Well, this one tells you what's included when you're looking at your debt ratio. So it's talking about all of your debt payments, and you also have to include your housing payments in there with that. So this one's giving an example of total loan and lease payments of $625. And let's just say your minimum payment on your credit cards is $240. That's just your minimum. So that's not paying more, and that's not paying it off completely every month. That's just your minimum of $240. Then it's giving you an example of the cost of your house. So you have a mortgage, your taxes are in there, and your heating costs, and that's about $900. And let's just say you have to pay child support of $400. So your total monthly payments are $2,165. That's all of the above. And we're dividing it by your gross monthly income. So when we talk about gross, we're talking about your actual income before Revenue Canada gets to touch their hands on anything. So that's before you pay your income taxes, that's before you pay any Canada pension, that's before you pay any employment insurance. So you're taking all of your monthly payments and you're dividing it by your gross monthly income before taxes, and you get your debt ratio. So this example right here, you're getting a debt ratio of about 35.88%. So previous slide, we had talked about it shouldn't be any more than 35%, including your mortgage. So as you can tell, this particular person is at 35.88. So this particular person is kind of teetering the line of it becoming probably very tight to manage his or her money when you're right at the threshold. Ideally, we want to be below it. Okay? Does that make sense? All good? I'm just going to, okay. So that's your total debt service ratio.
In here, Denise, I don't see any food or anything like that or expenses. That's not included.
That is not included when we look at a debt ratio.
Okay.
Okay. That's why I always come back to it being very important that when people are making financial decisions of what kind of debt they're going to take on, is that they really come back to their budget, because their budget will include your food, will include your gas, because everyone is different. So that's a bit of the concern that, as a counselor, that I see with banks just using a debt ratio, because that's the same debt ratio for everybody across Canada. So it does not take into account how many children you have. It does not take into account whether you drive an $80,000 vehicle or a $5,000 vehicle. It does not take into account whether you smoke or not, drink or not, take vacations, have extracurricular activities for your kids. So that's why it should never be your only deciding factor when you're taking on debt, because this is what it entails, is just this. Is your debt compared to your income. Okay, so it is just one. It's just one other tool. It's a tool that lenders use. So this particular person right here, if they were to go to a bank and say, "I really like to get another car," and the payments are going to be $500 a month. Well, the first thing the bank is going to go and do is say, your debt ratio, you're already at the max of your debt ratio, like you already have a car loan, you already have some credit cards, you have a mortgage, and you're paying child support. So the chances are is that you can't buy that second car or that recreational vehicle or that skidoo, things like that. So that's what the banks use, and that's something that is a bit concerning because it's for everybody.
Thank you.
Yeah. So the better your credit is, the chances are they will probably give you a little bit more if your debt ratio is 35.88. They may give you a little bit more credit if you have a really strong credit rating. They will sometimes go up to 40%.
Okay.
All right. So that's your debt ratio.
Do you want to do the poll?
The poll is at this point. Yes, please.
Okay. I'll set it up for you. I'm going to open up the poll.
Thank you. So the main indicator, sorry.
Go ahead.
Okay. So the main indicator for making an informed decision on the affordability of a new purchase is the minimum monthly payment. True or false?
Okay. I'm going to close the poll. And I can't vote, but I would vote false.
Okay. Yep, so that's the right answer. False. So what, so the question was, when making an informed decision on the affordability of a new purchase, you make it based on the minimum monthly payment. So what should it be if it's not the minimum monthly payment? Making an informed decision. Anybody have an answer for that?
I think it's a couple factors, not just the minimum, but the interest rate and the overall. If it's a loan, what's the interest rate? If it's a term loan, how long the term is, the overall amount. So it's a couple for me, it's a couple different factors I would really look into.
Yep.
But yeah, you never want to look at just the minimum, especially with any sort of revolving debt or line of credit, because you're never going to really pay it off, right?
You're never going to really pay it off. That's right. Yep. So that's a really good point that Corey has made, is that you don't want to just look at what the minimum monthly payment is, and that's probably with maybe just with education for Canadians when they're using credit cards or they're using any of the buy now pay later plans, is they're all tailored around minimum payment. Even car loans, if you're going into car dealerships, they're often just saying to you, oh, well, your payment's only going to be $300. So you don't want to just look at that. That's how they sell their products. You want to look at what the cost is going to be. So like Corey said, the term of the loan, how much the interest is going to be, the interest rate, and what it's going to cost you to borrow that money. Okay. So this is how credit works. A borrower borrows an amount of money from a lender, and the borrower must repay that amount of money, and they must pay interest. Sometimes the borrower may have to provide assets as collateral, and that would be an example of, anyone have an idea what that would be an example of when they provide collateral?
So if you're buying a car, you have the car as collateral. So if you can't pay off your loan, they get the car.
That's right. Same with your home. They have it as collateral. Sometimes it could be that you maybe have an investment that you don't want to cash in. Maybe it's savings that you've had over the years, or it could be an inheritance that you've been given to you by a family member, and you don't want to use that money because you want to keep it and let it build. So sometimes you may add that as collateral towards a loan of some sort. And how credit works is the lender may require a credit check. In most cases, that's how it will work, is they will do a credit check to determine whether they're going to lend you money or not. So we just have a couple more slides left. So this next one is talking about tips for success. Some of it we've already talked about. So determining wants versus needs, sometimes it's a little bit hard to do, but it can make it successful if you can break those two down and distinguish them. Involve your spouse, again, really important. Review your budget on a regular basis. Be prepared for the unexpected. And hey, we need to celebrate our successes. So budgeting, very important. And then when you're going along and doing okay and you feel good about it, then you need to celebrate. You don't want it to be restrictive because that's not very much fun. Avoid cash advances. And do we know why we want to avoid cash advances?
Are they high interest rate?
They are. So as soon as you take a cash advance off a credit card, for instance, you start paying interest immediately. Retailer stores, again, your Bricks and your Leons, those types of stores, they have very high interest rates as well. They may promote it that is interest-free for a certain period of time, for instance, but if you don't pay it off before that time period, you will have to pay interest right back to the date that you borrowed the money, which can be very high. In some cases, it's 29 to 30% interest. So those ones you would want to avoid. The cost of borrowing is the interest that you pay. So if you're paying 5%, if you're paying 29%, that's what's going to cost you to borrow the money. Total cost depends on a few different factors. That's the annual percentage rate that the bank or the creditor is going to charge you. The time taken to pay off the loan, that's the cost of borrowing, that's the cost of doing business. So if it's going to take you 5 years versus 10 years, you're going to pay a different amount of interest. And it depends on the method used by the lender as well. Sometimes they do it on an annual basis, semi-annual basis, monthly basis. So you'd want to know all of that in your contract. And any other additional fees. Sometimes some of those buy now, pay laters will have like an administration fee. So tips to limit borrowing costs. Don't borrow more than necessary. Use your savings to reduce the amount of the loan if that's appropriate. Shop around and compare interest rates and all fees associated with it. Make payments in full. So one of the pros to having credit, actually, which is not on the slide previously, is there's one great advantage to having a credit card. And most creditors give you 21 days to pay your balance in full. So if you make your payments, you pay off your balance in full within that period of time, then you pay no interest. Okay? So if you don't pay it off in full, then you're looking at having to pay interest. And then that's when it gets to be expensive. Find out if you can pay off a loan before the due date, and I think most loans you can. Mortgages are going to have restrictions on them, but a lot of the loans that are out there nowadays, they're pretty open and you can pay them off before the due date. And pay off your debts again as quickly as you can. That'll help save you money, and then you can move on to your other goals that you have in life. I'm going to share with you, which no, Corey probably has already seen this. I'm going to share with you our website and a recent post on there. Okay, which way am I going? So this is a recent article posted by our marketing manager, and it's payday loans. So I kind of found it fitting to bring this into play right now because we're talking about the cost of borrowing. And payday loans are one of the most expensive, it is the most expensive form of borrowing, and unless there's some off-the-street loan sharks out there as well. But a payday loan is very expensive, and this is an example right here on our, just a recent article. A $300 loan can cost you 546% in interest. So it's a very expensive form of borrowing. They are in Ontario, they are everywhere. I'm not sure what it's like in BC. Corey, maybe you can tell us if you see a lot of payday loan companies out your way.
Yeah, there's a lot here on the West Coast.
Yeah. How do they stay in business? People actually
How do they stay in business? Oh, they make huge money because the loans are designed. I mean, they're designed that for the majority of people actually have to reborrow. So actually, the majority of the loans, they're not delinquent. It's people that are stuck in a loop and they continuously have to reborrow. So you got to imagine how much money the payday loan companies are making when you have, hundreds of thousands of people every 2 weeks reborrowing because they can't afford to pay back the loan without having to borrow again to pay their bills. They're designed that way.
They're designed that way, yeah. So there's a cap that the government has placed on the actual interest rate. It is 59%, but they have a lot of other different fees that are designed in their loan, and it's a payday loan. So you're borrowing it, and then you're paying it back on your payday, which is generally within the next 14 days, for example. So that's why people don't understand the amount of interest that they're paying, because they're only borrowing it and paying it back. Whereas a lot of other types of borrowing, if you can't pay it all back within those 2 weeks, you have different repayment plans. Like your credit card, you make your minimum payment. Not always the ideal way to do it, but in this particular case, you have to pay it back that next payday. So what happens is people are short money when they go to pay back their loan, and then they have to reborrow, and they have to reborrow, and it's a very vicious cycle to get out of. So the government has the cap of 59%. However, it's the fees that's added in it, and it's the short period of time that you're borrowing that makes the interest rate so high. So it's a good read, and if you click on read more, you'll come to a full article about payday loans. It's something that we deal with every day in trying to help people get out of them and educate them, and sometimes it's just they prey on the vulnerable. Sometimes it's desperation, and it could be all kinds of different reasons why. But they're not only available in your town, like here in Trenton. Trenton is a very small town. There are 5 in town. They're online as well, so you can get a payday loan right online instantly.
That's
so, yeah. So this is our website, and there's lots of information in here. We have a learning center, you can see here. CRA, there's a free tax software. I personally haven't gone through that process yet, so I know people used it last year, so I can only anticipate that it's a fairly straightforward software. In our learning center, there's all kinds of different things in there. Budgeting 101 is Corey's brief on budgeting. There's another really useful website in here as well. I think it should be in this part right here. FCAC. Might not be in this particular section. Okay, so I'm just going to share another website with you. Can I just close?
These websites will be available in the after session email as well.
Okay, yeah. Can I just close and then open again to go to a different website? Or can I just go right up to the top and?
Just go there and put a new website in.
Okay.
Yeah.
So this is another useful website, Financial Consumer Agency of Canada. So that's the governing, Government of Canada. And it also has a lot of information on here about paying for post-secondary education, living as a couple, having children. A lot of what we talked about, I couldn't find it earlier, but you can link into understanding your credit report and credit score, a lot of what we talked about tonight. There's budgeting stuff in there. You can see one right here. It's called Payday Loans, Expensive Borrowing. Make sure you know what you're getting into. So this is another useful website to learn all kinds of different things. There's mortgage calculators in there. There's budgeting tools, credit card tools, all kinds of educational information for consumers in Canada. So all of those we will share with you. Okay, there is actually a couple more slides on joint loans, and a lot of people actually don't quite get the consequences of jointly signing when they are co-signing on a loan. So at least two people borrow the money together. They're called co-signers, joint loans, and each borrower is responsible for repaying the loan in full. So if one person doesn't pay, then the other person has to pay. So before you ever do that, sign on a joint loan, you want to make sure that you can repay the full amount. You should read the loan agreement. You should know your rights and responsibilities, and in some cases you may need to get independent legal advice. And consider taking out life insurance to cover the amount of the loan. So sometimes people don't hesitate to sign jointly on loans. And what they need to understand is that there's a benefit to the lender when they have two people signing on the loan as opposed to one. They've got two securities in place. So if could be mom and daughter, could be husband and wife, and then there could be a marital breakdown, and then the wife decides not to pay, then it's going to be the ex-husband's responsibility, or vice versa, and that can have a consequence on your credit rating. So you need to make sure that you can also make that loan payment, even if between the two parties, you're not the one actually paying it, you are responsible for it if you co-sign. So your responsibilities when you borrow: repay all debts in full and on time, borrow only what you can repay, understand your agreement, understand your account statements, and keep records of your loan agreement and repayments. These are all just normal responsibilities. Another website just kind of right here to your, I'm going to use my arrow here. There's another useful website called getsmartaboutmoney.ca. So this is another useful tool. So your right as a borrower is that lenders must provide you with detailed information about your borrowing tool, whether it be a loan or a credit card. It should include the interest rates and any fees. You should receive a copy of your agreement, and you may be allowed to make prepayments. So, for instance, in mortgages, you may be able to make prepayments, lump sum payments, pay it out early, things like that. So those are your rights as a borrower. So we'll conclude with a few key messages. Lenders and others use your credit report to judge if you are financially responsible. A high credit score can help you borrow on better terms. So that's the whole kind of premise and point behind this tonight, is that having a good credit score kind of puts you in control of your finances so that you can have better borrowing terms, have better interest rates, because the least amount of money that you're paying to a creditor, the more money that's in your pocket. We have also talked about checking your credit at least once a year. This will help ensure that the information is correct and clarify any discrepancies. Improve your credit score by following good credit practices. The counseling services are available to all military members and their families. They are free. They are confidential. They are designed to help assist with preventing financial problems and also with resolving financial problems. So it could be just a prevention stage, or it could be we need to resolve this issue. We do refer to third parties in some cases if it's outside of our control, outside of our mandate. We assist with all kinds of different things: budgeting, debt management, credit, education, accessible across Canada and out Canada. We have a toll-free number, and I've also the website, which I brought you to there a few minutes ago. So that's our counseling services. That's what I do every day. We exist to look after your financial health, which gets back to our vision, which is ensuring that all members and their families have financial health and security. We also have ways that have simplified members to help them save, which is the CAS Savings Plan, just kind of rejuvenated over the last year, where members are now able to save money a little bit easier because we can set it up as a pay allotment. We have expert money managers, and the fees are kept low to keep more money in your pocket. So this is all through Great-West Life, and the funds are provided by London Life Segregated Funds. This has been quite successful, actually, over the last year, and that we've had a lot of members signing up for the CAS Savings Plan, which has been great. These are all our different partners. We offer life insurance through SISIP. We have investments through SISIP, all through Fundex. We have our partner is the personal, which is car and auto insurance, Great-West Life, Manulife. We have the Canadian Forces Personal Assistance Fund, which is a program that we access different funds to help resolve financial issues. We also have Canadian Defence Community Banking, which is through Bank of Montreal. So those are our partners. So I'll leave the floor open for some questions and answers if anybody has any. Have a nice evening. Thank you.
All right. If there's no more questions, I'm going to stop the recording. Thank you so much, Denise. We really appreciate your information and your presentation.
Thank you. Have a great evening.